brings us to the high vol level, and we're going to go back to this chart, which is a net gamma exposure chart, to explain how this works and to break it down and how to read it. First, we want to look at the yellow curve that you see in the center left of the screen. This is the gamma profile, which really represents the gamma exposure for every for every strike price. And the high vol level, a lot of people refer it as gamma flip. We have our own methodologies a bit different. We believe it can help us get better accuracy on the data, but essentially is the level where the gamma profile curve changes from negative to positive. And that kind of dictates the gamma regime, which is positive or negative. So you see it here, we highlighted in the circle and the arrow. You see that this curve it's kind of like gets to the top and then goes and then follows through there. So it kind of changes from the slope from negative to positive, and that's where the level you see there, that's the high vol level there. So how do we use it, right? And then we're going to go into some example. So the high vol level can be used to identify the level below which a bearish feedback loop are likely to start, right? And that could lead to an increased market volatility. Above this level, the market conditions tend to exhibit lower volatility. So we tend to see kind of like lower movement, and you see it in the chart here. This was from this morning. I took it this morning before the presentation. We see that at the beginning of the day, the price kind of like stays pinned at the high vol level 0 DTE, and then we see a break, and that's when the volatility kicks in, and we see like a strong move to the downside. This was taken this morning. We're going to go into the chart in a second as well. So normally the high vol level can also be used as a major support level before the put support, and when the price kind of drops below the high vol level, the volatility tends to increase. All right. So again, this chart shows you that if the price of the underlying falls below the high vol level, the market makers' behaviors are shifting, and basically we are seeing an increase in volatility. If the price goes above the high vol level, we can potentially see lower volatility and kind of more stable price action throughout the day. Then one thing that we need to do is obviously look at the high vol level with the open interest. So we want to look, for example, if we've seen an increase of open interest day by day to see whether there are more opportunities for the market to drop below the high vol level. So here we see a lot of like red, kind of like high, like very wide bars below the high vol level on the right hand side. And so you can kind of like understand, okay, where is the market positioning themselves, and what happens if the price were to drop below those levels? How much really option contract are there? What could be the effect? We can also use it in conjunction with one of our other model, which is the implied volatility times open interest. Again, we want to monitor if we see a spike in strike prices that exhibit a large implied volatility and open interest, because that also could be a magnet or a reaction zone that could happen if the price were to drop below the high vol level.